There is a cult-like obsession with dividend stocks, especially among investors who want passive income without selling their shares. You get that notification on your phone that a check has cleared, and you feel like you've just received a gift from the market. But in the world of golden education, there are no gifts. What if I told you that dividend investing is a psychological trap designed to exploit your brain's preference for certainty over growth? Most people think dividends are an extra payment on top of their gains, but the real math shows it's actually a forced liquidation of your assets that triggers a tax bill you didn't ask for. Today, we're peeling back the free money narrative to look at the neuroscience of dopamine loops, the trap of mental accounting, and why chasing yields might be the very thing keeping you below the minimum threshold for true compounding wealth. Mental accounting. Why do dividends feel so good? It comes down to mental accounting, a concept popularized by Richard Thaler. Our brains don't see all dollars as equal. We put capital gains, the stock price going up, into one bucket and dividends into another. Because we see dividends as income, we feel like we can spend them without touching the principal. It's a psychological trick that makes us feel safe. But as a Gen Xer who has seen the rules of the game change, you know that safety is often an illusion. Mathematically, if a company worth $100 pays a $4 dividend, that company is now worth $96. You haven't gained $4, you've just moved $4 from your left pocket to your right pocket and likely paid the IRS for the privilege of moving it. If you took $20 out of your ATM, would you call that income? Because that is exactly what a dividend is. The real math, the total return, reality. Let's look at the real math. Many high-yield dividend stocks are actually value traps. These companies pay out massive dividends because they have run out of ways to grow. They are essentially admitting they can't innovate, so they give the cash back to you. When you focus only on the yield, you ignore the total return. For a generation that prioritizes DIY investing and autonomy, ignoring the total return is a dangerous game. If your stock pays a 5% dividend but the share price drops 10%, you are losing wealth. Yet, because of nominal loss aversion, your brain ignores the 10% drop because the 5% check feels like a win. The neuroscience, the dopamine trap. Dividend investing mimics the same neural pathways as a slot machine. It uses variable rewards. Getting that quarterly or monthly check provides a hit of dopamine that keeps you loyal to the strategy even when the math is failing you. This is especially potent for Gen Xers who grew up with defensive pessimism. We are naturally suspicious of market growth, so the certainty of a check feels more real than the possibility of a higher share price. Your amygdala, the brain's fear center, prefers the $100 in hand today over the $200 in the market tomorrow. But that preference is exactly what keeps most people below the compounding minimum. If you're only looking at the dividend check, you're looking through the wrong end of the binoculars. You're seeing the small win up close while the big loss is blurry in the distance. The Gen X context, suspicion of security. Many of us in Gen X treat dividends as a replacement for the pensions we were promised but never received. We are suspicious of security provided by others, so we try to build our own income stream. But this DIY spirit can lead us into yield chasing. We end up buying into dying industries, utilities, old tobacco, or struggling retail, just because they offer a 7% yield. We are essentially buying a sinking ship because we like the color of the lifeboats. Golden education requires us to stop being loyal to the feeling of a check and start being loyal to the growth of our net worth. The synthesis. The total wealth system. How do you break the trap? You pivot to a total wealth system. Ignore the yield. Look at the 5-year and 10-year total return, growth plus dividends. Audit the tax drag. Calculate how much you are losing in taxes by being forced to take income you might not even need yet. Control the liquidation. Instead of letting a company decide when you get paid, sell shares on your schedule to manage your tax brackets. A dividend isn't a gift, it's a forced sale. Control your own math. The deliverable and CTA. I've put together a yield trap red flag checklist for you. It helps you identify when a company is using a high dividend to mask a dying business model. We don't give advice here. We provide the golden education to help you outsmart your own biology. Subscribe if you want more deep dives into the behavioral science of your wallet.